I will be talking about homeowner insurance today. So first of all, I want everybody to know that to understand the replacement cost and the actually selling price is different. Because the replacement cost is actually how much it will cost to rebuild the home if anything happened. It's not the selling price. For example, in Fontana, if you bought a house for $500,000, for $1 million, but the actual replacement cost will be even higher because in that area the housing is not. It's different than the San Gabriel Valley. The house over here maybe $1 million, but actual replacement cost maybe only half of it. So we need to understand that. And for the insurance, you always need to insure the actual replacement cost, not the selling price. And then everyone needs to understand is the home claim is unlike the auto claim. Whenever you have a claim in your home, don't file the claim right away, because once you file it, the claim is already there. It will have the record and you would not get the claim-free discount next year and your premium will go up. So once you have a claim, talk to your agent and discuss about it. See whether it's worth to file the claim. And then we all need to make sure that you know your insurance, what it's covered. For example, some insurance company, they only covers fire, lightning, that's it. But for State Farm, we pretty much covers everything except for earthquake and flood, like windstorm, falling objects, explosion, and smoke damages. So make sure those are all covered in case anything happens, you are covered. And then another thing is that as State Farm, we do have something called agent draft authority, which means last time the windstorm in Pasadena, our agents actually go to their client's house and write them the checks right on the spot to help them out with all those loss of use, living expenses for up to $5,000, which is really good. You don't have to wait for the claim to process and anything like this. And then I'll be talking about loss of use, which is the additional living expense, food, hotel, rentals. We have unlimited, no dollar limit for up to 24 months, which is pretty good. If you have your rooms rented out, and that will have 12 months of rental cover. Well, I guess that's pretty much it. If you guys have more questions, let me know.
Okay, we all come home to our home, to our beautiful house, condo, mobile home, whatever it is. We come home, we're relaxing, we're resting with our friends, with our family, just ourselves, whatever, we're just at home, taking it easy. When all of a sudden, there's a big earthquake and your home is a mess, right? Unexpected, without warning, there's no season, there's no weather, we live in California, that's it. There's faults all over the place. We don't really, I don't think, check into that, but pretty much anywhere in California, you have the risk there's going to be an earthquake. So what are you going to do? You're going to be in a big debt if you don't have earthquake insurance, because you still have a mortgage, right? You still have to pay for it, even though you can't live in your house. Your house is a mess, it's destroyed, it's unsafe, whatever. You have to live somewhere else. So what can we do, right? You still have a mortgage, you still have to pay, but where do you live? You're not living even in your own house. So how can we help put that back together again for you? Well, there's different options. However, the earthquake through the California Earthquake Authority is the one I'm going to talk about, because whichever carrier you have might have a different plan. It might not even be through the CEA. The CEA, California Earthquake Authority, has 19 insurance companies participating. It's like a fund. They all bring the money in. There's like $10 billion in there right now to cover claims, so it's good. But not all companies are with the CEA. If you wish to know the names of the companies, I'll list a few just in case, and then you could talk to your agent to get a quote, okay? Because you have to go back to whoever has your fire insurance. It's a companion policy. You can't just go to, let's say, to another carrier when you have the fire insurance with me. You can't. You have to go with the same agent for at least getting the quote in that, or at least the same company. It doesn't have to be the same agent. I'll name a few. There's California Fair Plan, there's Safeco, there's Mercury, there's Allstate, there's Farmers, there's Foremost, and on and on. So I could give you some. So those are the common names most of us have, the AAA, the State Farm, the Allstate, the Farmers, that sort of thing. Okay, so what I just wanted to do is tell you a little bit about the CEA and how it works. And basically the question is, are you financially able to just rebuild your home without it? Because it is optional. No lender right now is forcing you to get it. So it's up to you. So basically, let's see here. What I'm going to explain to you is a little bit of what it covers and a little bit of what it doesn't and a couple of features of the CEA, earthquake. Basically, the company is focusing on the main house. So if you have a swimming pool, a spa, a gazebo, a patio, fans, even the driveways and all that, they don't help you with that. Okay? They're only looking at your house. And if your house is insured at, for example, $100,000, because that's what your insurance company said it takes to replace that house, that's what you're going to get on the earthquake side with the CEA. It has to match 100,000, 100,000. If you have a replacement cost policy on your fire policy, like she was mentioning, and it annually, let's say, increases in coverage with cost of living, so let's say the following year it's 120,000, and you have an earthquake policy, it will match to 120,000. They always have to have the same amount. Okay. Also, they're not going to cover your chandelier and your fine arts and the expensive stuff. It's basically just the regular basics to put you back on track. Okay. If you have 2 or 3 homes on a lot, you would need to have 3 CEA policies or 4, whatever. Each structure has their own policy. If you decide to buy it in the middle of the year, and your company, there's no like moratorium where you can't buy it because there was just an earthquake, you just all of a sudden say, you know what, I kind of like the idea, what would it cost, let's get it started. You can buy it in the middle of the year through the CEA or anytime. The only thing is that, not the only thing, the good thing I guess, is that they're only going to charge you pro rate just from that day forward, which is kind of a good thing. It's always an anniversary matching to the anniversary renewal date of your homeowners. Well, that's nice. As far as rates, if it's a 1-story house, you have better rates. If it's on slab foundation, it's better rates. The age of the home, newer, better rates. Frame construction, better. It's all, the rates are based on where the house is, the zip code, the location. If your home is older than 1979, they actually have a 5% off discount if you have 3 things. If the home is a crawl space, and you have the crippled walls, the post under the home braced with some plywood or something to retrofit the house. Your water heater's braced, and what's the other thing? What's the other thing? There's 3 things anyway. The fire, yeah, I don't know. I'll think about it in a minute. But there's 3 things that they look at for the 5% off. Okay. Then I'm going to explain to you a little bit of the internal coverages it has. Is it up?
The electrical update.
No, it's not that. I can't think of the other one, but I will in a minute. Yeah. The water heater braced. There it is. Okay, so the other thing I just want to mention is a little couple of things internally that whether it's a homeowner's policy, earthquake policy, or condominium, some match, some have a little bit different depending on what kind of policy it is. Basically, they have either 10% deductible or 15% deductible. You pick the 10, it's going to cost you more, but it is available. Okay. As far as contents, basic plan is $5,000. for contents. That's nothing, right? But some people say, I don't care about my stuff, I just want the house insured. Okay, you can say, all right, I just want the house and not the contents, or I want low contents. There's all kinds of upgrades. You could even go up to 100,000 in contents if you wanted to. That's why it's catered to how you wish to have it. Okay. Then there's additional living expenses that she talks about. If there's a fire and you can't live in your house, well, this is only regards to earthquake, not if there was a fire. If it's related to an earthquake, you can buy additional living expenses to help you live somewhere else temporarily. Basic plan comes with $1,500, but nowadays you can even not have it at all if you wish. Okay. Building codes. Let's say when they rebuild a house, the codes of the city have changed a little bit and you need to upgrade it and there's extra expense for that. It comes with $10,000 typically, but you can buy up to $20,000. Okay? So, exclusion, just real quick. It's not going to insure your pet. It's not going to insure your car. It's not going to insure your motorcycle. It's the house. Okay? They do have sub-limits also. Like if the chimney is just right, okay, then they're only going to go the maximum $5,000. Things like that. Money, the maximum, because you could say I had $10,000 in my house. No, the maximum they'll pay is like $250. Are we done? No, okay. So,
Excuse me, Leticia, you have 2 minutes.
2 minutes, okay. In regards to condominium, I'm going to add 2 more things that I believe are a little extra and different from a homeowner. In a condominium, you know how you have an HOA that covers the structure? So the CEA is not going to cover the structure. CEA doesn't cover anything commercial like an HOA structure. It's just the interior walls. And you can have it or you can not even have it. You just can have the contents. But condominium, we only cover interior walls. Do you know what interior walls are? The cabinets, the built-in appliances, and those sort of things, the fixtures. Okay? And basically it's what the CC&R say is your responsibility in that. What else? I think you pretty much have it. Either you have the coverage or you don't. It's your option. Ask me if you have any questions on anything. It's kind of cheap. It's only a $1 extra installment fee if you can't pay it all in full too. So it's something nice. Okay? Thank you very much.
And as you know, I don't oftentimes wear suits and stuff. And she says, you better look presentable. And it's been a while since I've dressed in a suit. So I had to have an image of somebody that I should dress like that is successful. So Caesar, stand up. See us? I bought the same suit and tie and shirt. Anyways, my name is Marco with Allstate Insurance. $23.99 suit store. Thank you. Remember, those that shop thrifty are the rich people. Anyways, what am I talking about? So you mentioned messed me up. 23 years in business here in San Gabriel. I'm an agency owner, and I'm delighted to speak to you about what the HO6 policy or the walls-in coverage. This is something that's newer in our industry. As realtors, if you're brand new into the industry, it's probably not new to you, but if you've been a seasoned realtor, prior to 2 years ago, if you were involved in a condo transaction and there was a loan on that condo, you didn't have to get a separate policy. The master policy was sufficient. Now, if you have a loan on it, and it's specifically a Fannie Mae loan, you're going to be required to get a condo policy or HO6 policy. So what is the HO6 policy about, Jimmy? Put this together last night, so hopefully it works. Oh, I have. See, I don't know how you did it. All right. Well, I wanted to, you don't want to take all of the work away from them. But anyways, it's a new Fannie Mae requirement, all right? Most of your lenders, you ask any lenders here represented today, and they'll say that their bank or their institution requires this HO6 policy. So why is there a need for it? Well, oftentimes, a lot of people just think, hey, I'm buying a condo, there's a master policy, that is all I need. And that is not a true statement, because a lot of times the master policy, or most of the time, the master policy only covers the interior structure or the common area. But the condo policy will cover many other things, and I'm going to go through with you on what that covers. So what defines then what structure the master policy covers and what structure the individual unit owner covers? And so let's just say that Vince, I'm a West San Gabriel Valley realtor. I sold Vince a condominium, all right? He's not going to know what is covered under that he's responsible for unless he goes to the CCNR of that association. We can have 5 different condominium complexes within a half a mile or a mile, and each of them could be totally different. So there's not a consistency in that. So the CCNR is going to be what defines what Vince is responsible for as far as interior structure. Here's some perils. This is wind damage. You can see that the whole roof is off. All right. We saw this happen when in December, tree falling on top of the house. Of course, fire. I had a friend that lost a 5-unit complex in Glendale, a condo project. So, actually, I lost the slide, but let me tell you what the perils are. So, wind, hail, smoke, explosion, falling objects. What is not normally covered is earthquake, landslides, all right? Those are floods. If it's outside coming in, those are not covered perils. Those are something that you have to buy on your own. So what is the dwelling limits then on an HO6 policy? As I told you, in the event that there is a loss inside the home, actually, if there's a loan involved, the lenders are going to require your clients to buy 20% of coverage for their interior structure. So this condo that I sold to Vince that cost $400,000, the lender is going to require me to put $80,000 worth of interior structure, so that in the event that master policy doesn't cover it, I'll have sufficient enough to cover what's Vince's responsibility. Naturally, we also know that it's personal contents. Yeah. And I'll bring all this together with pictures, because sometimes, you know, pictures help a lot more, a diagram than reading. But naturally, we would cover for all those things: wind, hail, smoke, explosion, falling objects, and some thefts with limited coverage. We would cover all of Vincent's personal belongings up to the policy limits. And it also covers loss of use. You've heard that many times with Tiffany talking about homeowners, Leticia talking about earthquake. In the HO6 policy, if those things had happened where you saw those perils happen to the condo and Vince isn't able to stay there, many HO6 policies will provide money for him to stay someplace else while that's being rebuilt. The master policy will not. And then there's liability, which is broken down into 2 aspects. One is personal liability, one is medical payments, all right? Personal liability, oftentimes policies come with about $100,000. This is for the interior liability that, or personal liability that Vince and his resident relatives are responsible for. So if they get hurt outside in a common area, they're in a complex, you guys come visit, you're outside in the pool area and all that, you get hurt, that's going on the master policy. You get hurt inside Vince's condo, they pay, master policy pays $0. If he doesn't have that, he's going to be up a creek. Can you go bring up the diagram now? I'm going to bring this all together. I know this is a 30-minute normally training session, and I'm trying to put that within 10 minutes. But again, I'm going to use real live West San Gabriel documentation. $400,000 sales price. I sold Vince this condominium. The lender is going to require how much? $80,000, because it's 20% of the sales price. Drop down. We had that. The master policy has $1 million coverage on it. All right, and unfortunately, the 5 units burned down, and it cost us $1.2 million to rebuild. So how much am I short? The answer is up there, people. $200,000. Good answer. All right, we're short $200,000. All right, come on down. So the first thing is, Vince, he didn't like all the Formica, he didn't like the linoleum tiles and all that. He went and put upgrades on it. Let's just, we want to go one at a time, so go to the, cover just one. She wasn't in the training session, I had the other girl. Anyways, so Vince put $35,000 worth of upgrades in his condo. Is that unrealistic? Anybody?
No.
All right, it's pretty a realistic figure. That $35,000 of him upgrading the granite or the bathrooms or the kitchens or putting in new cabinetry and all that, $0 of that is going to be covered by the master policy. All right? So, as you can see, 0 on master, the HO6 would pick it up because why? I have $80,000 worth. Do you guys see that? That's the interior dwelling structure that he's responsible for. What defines what he's responsible for?
CCNRs.
You guys are a great class. Second one, contents. Vince owns a lot of nice stuff. Italian paintings, statues, designer suits. He doesn't go to the $99 store. He buys $1,000 he has a Mona Lisa. All right. Well, let's not talk about your private life. Anyways, $47,000. Master policy 0. The HO6 would pick that up. All right. Next one. How long is it going to take for us to rebuild if the 5 complexes went down? Let's just say it was 8 months. Is $2,000 a month for him to get into another condo to rent unreasonable?
No.
Somebody said yeah? No? Most of you are saying no. So it's a fair rental market, right? I can find him a 2-3 bedroom, right? So let's just say it took 8 months to build. I took 2,000 times 8, that's 16,000. Again, 0 and master, 16,000. Now I'm up to 98,000 if he hadn't had this HO6 or condo that the master wouldn't cover. See, I'm adding it up on the right side. Go to the next one. Loss assessment. What about that 200,000 that the master policy didn't cover? Who has to come up with that? I heard the answer. Each individual unit owner. It's called assessment. Basically, they'll take what is not covered by the master policy, what was over and above the master policy, divide by the number of owners, and Vince is going to be assessed his proportionate share, which is 40,000 in this case. All right. If you have that endorsement, most policies pays up to 50,000. So again, now we're up to 138,000. Right. Let's go down to the next one. This is the liability. So on the whole, is most of that. Let's just say that Vince threw a party, and like I said, you guys came to his party inside his home, and somebody slipped and fell inside his stairwell, all right, and they did not have any medical insurance. Guess who they're going after? Because they have, that's right. Or let's say he doesn't have, if he has a dog and it bites somebody, all right? Again, that is personal liability. Or let's say that he was playing golf and he happens to hit somebody on the head, David Tran. He's walking, not paying attention, and unfortunately on the backswing, he gets nailed by Vince's. Not intentional act, but he gets hit. That is basically personal liability. Master policy covers 0, the HO6 policy covers it. All right? So the last thing I want you guys to do, bringing it, now you're forced to do it, so it keeps you out of trouble, because if there's a Fannie Mae loan, your lender is going to require it. So on the whole, you are going to get most of these coverages. But where you guys get in trouble, especially in this market, and this is my number one thing that I inform realtors, is when you're dealing with an all-cash buyer. Let's just say that now Vince is an all-cash buyer. He had $405,000 in his pocket, in his bank, but he didn't want to. He's retired, he has Social Security, but he doesn't want to have debt. So he pays the whole $400,000, right? For the condo. Vince asked me, hey Mark, do I need to get this HO6 policy? And as his West San Gabriel Valley realtor that didn't go through Mark Wu's training, I go, Vince, don't worry about it. We can close escrow without it. Right? And I hear this time and time again from realtors, and I won't point you guys out, but I know you guys don't do it anymore. But that one statement can get me in a world of hurt as a realtor. Because let's just bring him back to this situation. And now, a year later, we have all these situations. And what is Vince going to remember? You.
Don't worry.
Mark Wu from West San Gabriel Board, realtor, told me I didn't need to get HO6 policy because this was a cash deal. Guess what his attorney is going to do? Let's not use the word sue, but they're going to be coming after me, right? We don't want you guys in that position. We don't want your brokers in that position. So please, 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 when you're dealing with the all-cash buyers, whether it be in homeowners, earthquake, or condo, always recommend the insurance, and that will keep you out of trouble. As far as and that's basically my talk. As far as the 5%, Leticia, it was also a water heater strapped down. So in order to get the CEA.
Mark, lawyers have teeth too.